Okay, so I'm Tyson Halsey, Income Growth Advisors. I've got several people on here. We're going to talk about the Great Rotation. I'm going to flip over to that presentation right now. Give me a moment while I share this. And so the Great Rotation, I think, is very apropos for the current market environment. It relates to going from all the mega caps to everything else. And today I'm joined by Mitch Belagic, who's going to speak next. He worked initially, he actually worked with me in Helsinki around 2000, and he was a quantitative strategy at IT, strategist at ITG, and then went on to work for some other big hedge funds and now works in artificial intelligence. And I have Rich Gula, who you all know, and he'll wrap it up. And he's got a bunch of charts. Tony Lobier and Chang Q, who both spoke on China last week or 3 weeks ago, and Charles Zhang, who's a colleague of mine and has been working in quantitative models for 12, 15, maybe almost 20 years, probably 15, I guess. Anyway, I think there's something they say about experience and the value of it. And one of my experiences is I had a tech hedge fund in the late 1990s, and it did great. And during that period, the market went parabolic on the upside of the Nasdaq 100, which you can see here. Basically doubled in about 6 or 9 months. And frankly, I think we're in a similar sort of situation. And basically, anyone who's taking calculus understands that you can start to grow at such a fast rate that it is unsustainable to continue to grow. And that's what happens when things go parabolic. I think you saw it in NVIDIA earlier this year. And basically, we've seen the same thing now happen in the NASDAQ 100. It's up 94% in 18 months. And most notably, we saw NVIDIA take off. My concern is after a period like this, usually that's a major top. And one of the things that often is a very important indicator of where stocks trade, how they're valued, is their earnings. And I use the Fed risk premium model. And basically, we can track on a very real-time basis, not day to day, but weekly, where the earnings trend on the S&P 500 is. And when that trended down in 2000, after we got a peak until 2002, the market went down 52%. The NASDAQ went down 83%. We saw a similar collapse in 2007, but it was in 2008 that things suddenly fell out of bed and bottomed in March of 2009. You saw them roll over during the March collapse in 2020, and there was a sharp pullback in 2022. But actually, the earnings, the market anticipated that first, and then you actually had this one subsequent blow off run here. And my concern, my sense, I think Tony would certainly agree that there seems to be a lot of signs that a recession may be at hand. And if we start to see earnings roll over, I think that could be very troublesome for the market. And just to drill down, I like to look at the risk premium, which compares the earnings yield of the S&P to the 10-year U.S. Treasury. And when it is negative, such as it was back in 2000 at the peak, you don't want to be in the stock market. You want to buy it, when the market is cheap, which was in 2009, 2012, in 2020, and it was starting to get expensive. And then what happened here is basically earnings have stalled out, but interest rates have come down because I think there's a perception of a recession, and less. I got to add some people, pardon me. Um, But basically, what happened is you saw inflation come down. People felt a little better. The 10-year Treasury dropped into the three range, um, and the risk premium actually went up. So the market looked a little better. But frankly, what's happened is earnings have flattened out. They're sitting around that 241. They've been that way for a couple months. Now, as we come into October, I think if we start seeing indications of a earnings slowdown and guidance that way, things could start getting problematic. I also think that from my experience doing the CFA program, fundamental to any security valuation, interest rates are critical, particularly for stocks, bonds, and real estate. And over the last 40 years, you've had interest rates declining from 15, almost 16% all the way to a half percent. I think that tailwind is gone. And so you don't want to be caught in overvalued stocks. And I think that one of the factors that we have going on is we had this bubble like behavior, this parabolic move here in NVIDIA, and that was in June. And just to harken back to past glory days, I'd had a hedge fund in 2000. It was up 112% in 5 months, and I got out at the top. But I actually, frankly, I didn't know what to do. I just knew tech, and I kept on looking to buy tech on the pullback because, well, that was a mistake. What I've learned, and this is why I kind of beat this drum of rotation, is had I then taken all the profits I had had and put it into China, and put it into gold, put it into oil, those markets were up 5 to 10 fold. China closer to five, but gold and oil actually were up tenfold over that period. So the idea of rotating away from the big cap tech, I think, is a story that can be repeated here. And a good example of a broadening out is shown by Ari Wall. This is a couple months old, but you're hearing more and more people saying, "Well, it's the equal weight S&P is starting to perform." It's because other stocks that have been left behind the cap weighted S&P are starting to respond better. Now, a good example of a non-correlated or diversification play would be gold. And I think gold is doing very well and will continue to do well. It's outperforming. It doesn't have to worry about what the S&P earnings are or even the price of um, bonds or interest rates. And I think another area that had a really interesting move here is China. And we were talking about that 3 weeks ago on the 12th. And I was very keen on that. And one of the reasons I was keen on it was my friend Mitch Belagic was telling me why he liked it. That's me. Mitch, do you want to now speak on, do you have a presentation or do you just want to speak? Mitch, you there?
Yeah, I'm here. I was on mute. I can speak just since it's only 5 minutes. I mean, I have some slides and stuff, but I
Go
can leave
ahead.
that for later. Um,
Okay.
but anyhow, you asked me to give my macro overview of China, which is I have experience in the last 20 years of actually traveling, working in China just to double check and to see with my eyes, feel with my hands what I'm reading and researching. But generally, just want to mention, I guess ground zero is this latest stimulus package from China. That's a good starting point. Let me talk a little bit about the assumptions in Europe and US, especially in the US. Too little, too late. Nothing is going to activate the consumer. Real estate is in the dumpster and will stay there. This is not a boom economy, of course. I think the truth is somewhere in between. And if I'm right, there's an enormous upside there because being between doom and gloom is really like a place where you want to be. So, what I would actually just mention. So, first of all, let me start with the property market, which was like the big problem. I think one of the big misconceptions that people understand that Chinese government is deliberately allowing large real estate developers like Evergrande and Country Gardens to fail. And their intention here is only to stabilize this market, not to enhance it. They're not looking this is a big capital investment or a big growth factor like in the US you would. They just really want to stabilize the real estate market. Is there upside? Very little. Downside? Absolutely not. As far as the stock market, similar story. Chinese economy is much bigger than the stock market, the other way around in the US. And there hasn't been really steady correlation between the two. But having said that, Chinese government really has an interest of actually boosting the stock market. And I think that's one of the motivations of the stimulus package. That is just the beginning. So one of the assumptions is too little, too late, not early, somewhere in between. Too little, no, this is yet to come. I think the much bigger stimulus package this will be coming. Now, the economy itself, one thing that I think is massively underplayed or really not understood in the West is that how China actually dominates the global export business. And now I call it the 2.0. And first of all, one misconception is that China cannot export itself into growth. It's too late. Then the sanctions and this and that. Yes, China is going into a transition to consumer economy, but that's not their growth, that pattern. That's a long term. Let's see how it happens and how it pans out. What is critical here is that what I call a China export boom 2.0. Well, first of all, let's start with trade balance with the U.S. Last I know is that the trade balance with the U.S. is back where it was before COVID. So much for nearshoring, offshoring, building chip plants in Nevada, and so on. But the real growth and quality growth is in the global South. And this is something that's going to transpire in the next few years and take full scale in the next 10 years. Is basically what China is doing is incredibly shifting its export boom to the global South, but not just exporting, like selling cars and toys and stuff like that. But they're actually going full in. They're building infrastructure, know-how, they're transferring technology, they're educating a massive thousands of engineers from the global South into China, and they're integrating this economy into much more than just export economy. Now, this is actually one of the principles of the BRICS. And basically, BRICS is just going to be amplifying this. So the fact that their growth is still pretty impressive as far as the export, this is their big engine growth that I think people are really not understanding. So in my view, I think that this is a long-term play. Yes, if you look at the short-term play and look at the stock market, what it's been doing and the stocks and whatnot, I agree with the concept in the next 3 months, because not just because of China, but because of geopolitics, macroeconomics, and the elections in the US, is wait and see. Quick trading thing, I'm a trader too. I trade primarily derivatives, but my view in China is in the next year end, pretty much a range market, buying on dips, good opportunity to sell volatility, the extreme volatility that's going to be fizzling out, even though there's a lot of issues in the world today. 2025 is, pending some serious recession, is a growth time. Where I would be focusing right now in China is on technology stocks, especially telecoms and fintech. I think they're going to be the key. This is not just because this is the government plan to boost their technology sector and be independent of the US, but this is something that China has been focusing on the last 10 years. We are way beyond that, China stealing technologies and IPs. I think now probably be the other way around. And just to quote an interesting article from the Australian Strategic Institute, which is not China biased, it's actually very Western biased. So their analysis showed that from the 44 leading technologies in the world, most important technologies in the world, China has an edge over US in 37. So saying all that, I just find it incredible to think that China is at the end of the year, China's imploding, too little, too late, and so on. I think this is a great floor here and a great buying opportunity, and particularly in tech stocks. In fact, I would dare to go long Chinese tech against US techs easily for the next year or two, which is probably one of my best trades, along with selling shorter term iron condors and long term vertical spreads with with leaps. But that's kind of a quick overview of China. We can talk hours about this, but
Mitch, just one quick question. Great,
sure.
great thoughts there. Well, you said the China South or South China or something? I didn't
No, I
get what
said
you
the
said.
global south. I said the global south. We're talking about the emerging markets or the third world, is called before, not China South. China is
Okay, I know
actually
what the
the
global South is. Thank you.
yes, the
But
global
I
south. Yeah,
didn't
that's
hear it
what
right.
okay,
Great,
sorry.
great
Excellent.
thoughts, by the way.
Thank you, Richard. Thank you, Mitch. Let's go with Tony Lobier, who had pitched last time BYD and DQ, and then we'll go on to Cheng Q and Charles Zhang.
Mitch, I'd just like to ask you, where are you? You've got a beautiful background there.
Uh, Miami Beach, Florida.
Okay. Um, Look, I think China is still very underrated. And I think I am really impressed with some of their technologies. And I think particularly in the automobile space, I think they're changing the world. I mean, you look at their electric cars, they're making good cars. They're making quantumly cheaper than anywhere else. And I think they're better. And it's not only electric. I mean, BYD announced a hybrid vehicle that will get you 1,300 miles on a tank of gas. Now, I don't know how they accomplish this, but I assume they're not lying. And I think this is a huge achievement. And it is also a huge achievement, despite the subsidies, that they can sell a good quality electric vehicle for $9,700. And meanwhile, you have Volkswagen, who's trumpeting how they've reduced the price of the electric Skoda to $33,000. I mean, a lot of the existing car industry is totally uncompetitive. And I think you can do what you want with tariffs, but basically you're fighting City Hall, and the Chinese are way ahead. I think that BYD in particular is in the initial stages of a huge bull market. I also really am starting to like solar because it's very depressed, and we're going to need a lot more electric power. And the whole idea that people are placing on these small nuclear plants, may be misplaced completely, because there've been nothing but huge cost overruns in this space. But in addition to that, to get them built and permitted and everything else is going to take donkey's years. So I think if you have a power shortage, you're looking at natural gas, and wind has been having a lot of trouble. So I think you're looking at natural gas, and you're looking at solar. And I'm really intrigued with the fact that solar is very depressed. And if you go with Mitch's idea about the southern countries, well, then most of them have a lot of sun. So so I think solar is really interesting, and I still really like DQ. Now, having said that, I have one short-term concern, and I think that if Trump wins in November, you're going to get a big correction in Chinese stocks. Now, I don't think Trump is bearish for China. Quite the contrary. I think that if Trump wins, he's going to antagonize everybody, and that's going to be, in the long run, very bullish, not bearish for China. But the initial reaction, if Trump wins, is going to be a sentiment that this is the end of China. So, I hate buying on extreme strength. It turns my stomach upside down. I think that the U.S. is way over promoted, and China is still very cheap. One other thing I would mention on precious metals, and I don't know how this plays out, but there are a lot of bulls in precious metals, including me, long term. But with what China does, if they follow through, it's gonna the way down for interest rates could be a lot tougher than people think, because China has been exporting deflation, and I think that's no longer going to be the case. So I don't like the U.S. market. I like China long term. I'd like to see a better opportunity in precious metals. You may have a real opportunity in some of the industrial commodities. I'm watching that very closely, and I'm talking again about improvements in China, because if China does get better, all of a sudden the hedge funds are going to jump into these industrial commodities, and
Copper, steel.
Copper, steel, maybe fertilizer, zinc. Again, I mean, and this is totally out in left field, but if BYD can do what they say they can do with a tank of gas, that is not bullish for the oil market. So that's it. I think we're headed for some kind of credit crisis in the U.S. next year. We'll see.
Thank you, Tony. That's great. You were spot on 3 weeks ago, and I don't blame you. I don't want to chase these stocks either, but the question is, where do they go in the long term?
Well, again, if Trump wins, there's going to be a correction, even though I think, as I said, I think Trump is very bullish for China. But I think that if he wins, people are going to say, oh, the tariffs. But you really can't fight City Hall. And, China's technology, I think, in many areas, it's much better than they're given credit for.
Seems to be what Mitch was saying with his, 37 out of 42 technologies. Let's move on to Chang Q, who I introduced couple weeks ago, but who I had found on first call back in 2003, and he gave me a bunch of Chinese stocks, and it was fascinating because at the time, 2003 was the end of the tech bubble. And suddenly, all these Wall Street firms, which had started covering internet stocks in China, were dropping them. They were just dropping coverage or putting sells on them. And this one guy was, these stocks are dirt cheap. They're trading at cash. They should soon earn some money. And Sina, Sohu, NetEase, and I think the fourth was Tencent. They all went up about tenfold. I did not hold them for the full period, but I had met Chang then. And then when Tony started talking to me about China, I reached out and called him, and he gave us a couple stocks, I think that are up now 60% in 3 weeks, Wybao and BDD or Pinduoduo. But I will let Chang Q now just tell us what he thinks of the China market, what names he likes, and go ahead, Chang.
Okay. Yes, thanks for Tyson, Mitch, Tony for your talks and the introductions. For this time, I think the September 23rd, this stimulus announcement is was quite surprising in terms of, even the most recent China's major meeting, the parties meeting in July. That's their third, major meeting with all the top leaders of the Communist Party. They did not, allow stimulus or major stimulus policy. Now, I think they waited until the U.S. Fed to reduce the interest rate, and then that reduced the depreciation pressure on Chinese renminbi. So they announced, reduce the interest rate in China, reduce the reserve ratios, and all the stimulus package rolling out. So in a sense, maybe waiting for the Fed. Another sense is maybe the Chinese economy is becoming very, very weak. I think Mitch mentioned, several points there. Another point I'd like to add is they released the youth, the young people's, the unemployment rate is very high. It was the official number is 18.8%. That's even higher than the last highest number a year ago. They released a high number. I all mean official number 18.1%. That's the earlier high. Even though the private number, unemployment number is actually much higher. So maybe they roll out the stimulus policy because of the economy just too weak. So for any reason, that's a kind of unexpected move. That's why the market response is also quite violent. Many stock was coming up 50% or more. Going forward, what I'm thinking here is obviously, I think the question on investors' mind is how sustainable is this move. And so far for the names I mentioned, the PDD and the Weibo, I think the valuation is still very reasonable. Even the move is quite violent in the last 2 weeks. Reasonable is because PDD, the valuation ratio right now is around 10 times. And the Weibo WB, the valuation is around 6 times earnings. And on the technical chart, you can see they basically get to the earlier beginning of this year, December 2803 kind of a value in terms of stock price, which means for the year, even after the recent move, they basically flat in terms of a price. But I think going forward, we will see some maybe pullback. People will take profit for the recent buyers. But in the longer term, the valuation is still quite appealing, I think. It's not stretched at all. Especially if you look at the sentiment, I think a lot of investors basically kind of say, "Oh, the rise is too fast. It's too quick and too fast," and it will be end up with like in the past when there was some stimulus, and then after a short period of up move, and then gave up all the appreciation in a few weeks. This time it could give up some of the appreciation, but it could, I think some of this will last, especially if, the stimulus really get people, less worry about the future, build up some confidence. And if we can watch, some of the consumption, is resumed. For example, one of the measure is they will give out like 150 billion renminbi, that's like 20 billion US dollars, to the very poor people in China. So I think that's definitely will stimulate the consumption. I actually personally, I believe if they, gave out more money to the poor people, that will help the consumption even more because the $20 billion, that's a very small amount. Even US, if in the COVID period, we have, several $1,000 per people, per person. In China, if you do like that amount, that's like get to $1 trillion kind of a amount. So it's not that big. I hope they will get something bigger. Yeah, that's what I think I have for the update right now. If another thing, if people want to watch whether this is sustainable, is to watch or to see whether the China space, the appreciation of the China names can expand to more of the micro cap space. Many stocks in the micro cap space, they are still like maybe 50% or more lower than the earlier of the year number, like the December 28, 2023 price level. So I think if the stimulus is keep rolling out, those smaller companies will benefit as well. I think initially it's all the bigger company like the Pinduoduo, the Alibaba, the Jiandong, the Baidu, those are going up first. But then maybe we have some spillover to the smaller, the micro cap names. We will see for those.
Okay, so next month we'll have a list of those micro caps trading at cash values or below that are about ready to explode. Thank you, Cheng. Charles Zhang is now going to speak. Charles has been a great collaborator and aid to my efforts at Income Growth Advisors since 2006 or 2008 when he started as an intern for me, and he was a remarkable intern then with double 800s on his SATs, and he still reads and corrects my letters, though I always make all the corrections. But then I'm reminded that Chinese is his first language, English is his second. But he's a real whiz at computer programming and did some things remarkably. Has done a lot of quantitative analysis. And he had been talking to me about one particular strategy that he's using very actively now that is based upon kind of unusual factors where you get an unusual move in a sector, and then you will have follow through and how to trade that. And it seemed apropos that he speak about that because that seems to be precisely what is going on with China. And Charles, if you go ahead, take some time, talk about how that strategy works, what the concept is, what you can read into it in terms of China, and then if you have any thoughts as to China stocks you would or would not want to be involved in. You got
sure, of course. So I want to talk about the recent Chinese stimulus and how the quantitative strategy Tyson and I have been working together takes advantage of news events such as this one. So to give some context, like why the recent Chinese stimulus is so important, I want to talk about the changes in the Chinese economic growth model. So for the past 10 years, China has been relying on housing and infrastructure to grow its economy. But both are no longer working because there's a lot of debt on the local level. And you also have sharply declining demographics, which impacts both future housing demands and the future taxpayer base. So as Mitch has mentioned before, China has been trying to shift to a more consumer-focused economy. But unlike the US, China didn't provide enough fiscal support for the average person during the COVID years. Therefore, many small companies in China didn't survive these years. And together with a declining housing price, just for context, for average Chinese household, housing is about 60 to 70% of their net worth, comparing this to 20 to 30% in the US. So housing prices has a far more impact on the wealth effect of a Chinese household. So it's not really surprising that the Chinese consumer spending has been very weak lately. The recent stimulus from the Chinese government is a huge surprise because it signals like a philosophical shift in how they're dealing with economic slowdowns. Because previously, they have been very reluctant to do any kind of physical support. They've been primarily helping their banks and buying stocks in the stock market, but not directly helping the average person. Let's shift back to the quantitative strategy Tyson and I have been working on. Our quantitative strategy takes advantage of a phenomenon called post-earning announcement drift. Basically, significant news surprises in the forms of earnings, industry-changing news, company-specific catalysts. They do not get priced into the stock instantaneously. They tend to get priced in over time. So the recent Chinese stimulus qualifies as a significant news affecting the Chinese ADR group as a whole. I mean, pretty much any Chinese ADR stock has gone up at least like 20 to 50% in the last week or so. Many of these Chinese ADR stock prior to the first stimulus news has been in consolidation prior to the news. So our strategy would be we will buy the breakout on the stimulus news. Since we don't have a crystal ball into the future, if we want to buy additional share now, we need to wait for these stocks to go into consolidation again, because that allows us to have a fairly low risk weight to buy. Like our strategy do not chase stock. So it's up to the Chinese government if they announce additional stimulus in the future. That's all I have for us right now. I'll shift back to Tyson Halsey.
All right. Thank you very much, Charles. So I think that brings us to Richard Gula, who's going to go through a couple names. I'm going to share a screen, and then Rich will tell me um, when to change screens. So right now, this is a little bio, institutional market analyst, quantitative. He went to Harvard undergrad, grad, studied psychology, worked for Dean LeBaron, also under Ned Johnson over at Fidelity, set up the chart room, and really has a good feel for where a lot of institutional money is flowing. He consults to about a half dozen portfolio managers at Fidelity this day, and he just throws them charts and tells them where he sees things, and they pay him for that service. And Rich is honored to be able to share his insight with us today. So let's see here. Boom. So here we have a chart. Go ahead, Rich. Rich, are you on?
All right. Am I on?
You are.
I am. Wonderful. If you could start with the first. Yeah, the first chart is something that popped up. I think I stole it from somebody on LinkedIn, and I don't mean not to give them credit, but it takes a number of rallies in China and it overlays them on one another. So it's not unusual for the market to begin these kinds of runs historically, although I would say that in a modern liquidity-driven world, this is a little bit different for obvious reasons. One of the things I would want to remind everybody is that when you're looking at breakaway charts, you can go to the next chart, please.
NVIDIA.
It's actually Taiwan Semiconductor.
Oh,
And it's a surrogate for NVIDIA inside the semiconductor world, but it's
Taiwan Semi. You're right. I'm sorry.
Yeah. And the reason for pointing this out is that if there's a rotation above and beyond the response to the stimulus package, virtually all the global semis are in some kind of difficulty in terms of rallies being sold and the buys at the lows not having as much money coming in anymore. ASML in Europe is a good example as well. So it's not just the US semis. The outlier here would probably be Intel, where it's now in a value stock category. We go to the next chart, please. There's
Impressive charting.
Well, there's three charts in a row here for different variations on the Alibaba group. And I think what I'd like to mention here is that this looks pretty interesting, like it's a breakout right through old levels. You go to the next chart. Unfortunately, you put it back into context, and it's not quite as positive, to say the least. The Chinese, this is as serious a decline in Chinese equity sponsorship as we had in the dot-coms back in 2000, 2002. These are major league declines. And obviously, if you go to the next chart, here's the pure Baba, as I like to think of it, that was floated in the U.S. Remember, there was a great deal of fanfare with Jack Ma. And there's either a long way to go here, or you've got to be a little bit careful in terms of what you're going to get in the next, say, 3 to 6 months. I think this is a pretty good breakout, but it's not necessarily for the reasons that a number of our speakers have mentioned, who know a great deal more than I do about the stimulus packages. I've always looked at this in terms of who's the sponsor of this once the news hits. Oh, fact number one is that China was 40% of the emerging market, MSCI emerging market index in 2020, and it got down to about 24 recently, and it's back to 27. 27 is it's there with India and Brazil as being major weights. The The sponsors right now, the most prominent one, other than Tony, I have great respect for your Argentina purchases. I wandered around Argentina 30 years ago, and it takes a certain investor with foresight to go there. But your competition right now is Tepper, the guy that owns the Carolina Panthers, who's gone on to runs hedge fund out of North Carolina. Went on in CNBC and basically said, buy everything in China. Okay, so you have sponsor number one. Number two are the managers that have exposure to the MSCI Emerging Market Index. I guarantee most of them were at 12%, not 24% at the trough. Third, you're going to have funds like CalPERS. Do they have exposure into emerging markets right now? Is there a political issue here? Does that vary globally? Some of the European pension pools are enormous. The Dutch was always one of the largest in the world, but a number of the Scandinavian funds are large as well. Fourth, it's portfolio managers. Fidelity used to have a holy trinity of Sina, Baidu, and Sohu. Whenever they needed exposure, those are the three stocks they'd buy because they had pretty good coverage internally. And now the last sponsorship that's pretty important are the ETFs that have easy exposure. And I think this is a place where you could get more retail interest into the end of the year, especially if domestic stocks seem to have a problem. So with that in mind, let's look at it. All the charts are going to look pretty much the same. They're all breakaways. These are not high reliability patterns, other than those that love breakaway models, which are perfectly valid, but in my experience, are pretty hard to figure out when they run out of gas. Next chart, please.
That's the FXI. Now we're going on to.
And the FXI is the easiest place for anyone from RIA group to the Schwab, Fidelity, wealth management folks. If someone's calling up and wants to buy, they're probably not going to say no. But there's your history. This is a much safer place to have been than in individual stocks like we saw before. Next one, please. The Tencent obviously has a much stronger pattern to it that's had pretty good sponsorship right along. But notice that it was in a full-fledged sell-off into that announcement. I would urge everyone to consider, through at least what I've heard from my local sources of people who are ex-Chinese expats with pretty good sources back into China. Almost everything in China is managed. This isn't happening without obviously the blessing of the CCP, but also it reflects some kind of worry on their part that sell down. There's two ways to look at the sell down. One is they knew something was wrong that they had to sort of counter. The second is that they wanted it to go down because that's a very good stock for Chinese investors to be in, because it's pretty visible and highly reliable in terms, relatively speaking, on its accounting standards. Next, there's Sohu. Notice Sohu doesn't look anything like the other stocks. Very few large scale managers with an emerging market allocation would have been out of China. And so I'm guessing this would have been a core holding no matter what. Next, it's the Chinese internet stocks. This would be the other ETF. If someone were calling me up and saying, I want China exposure, and if you're wrong, I'll only remind you when we're playing golf. And I would say, okay, then use one of the BABA, Tencent, et cetera, stocks, use the FXI, and then get exposure here. These folks aren't going to get down to the level of sophistication of the sort of ideas that have been presented here today. Next, please. This is in fact the MSCI index itself on China. I haven't get a chance to go and look at the weightings there, but I'd be if I were going to have an exposure, I'd also be buying the top 10 weightings here as a core, and then work around that with the names that you really like because of specific information. Next is Yum China, and this again also would be a core institutional holding because it's highly visible. So, and then lastly, I hate to tell you and remind you, but the U.S. derivative equity people have found a way to go after China as well. And this was suddenly trading 4 million shares a day. It basically is a 2x on the China internet index. So there are these leveraged ETFs that are going to add momentum on any given update. And I think that's the last slide.
No, you asked for one other one, HK or something? No.
Oh yeah. One of the things you also look for, it's a good thing at this point. You want some speculation to come in from the retail. My quick research on this was a Hong Kong listed stock where you're allowed to go trade the Chinese stocks, and this is not going to be something high on the radar of any American advisory group, but it's certainly going to be active in Hong Kong. So buyer beware. But I certainly, if I were short and had someone calling up, I wouldn't return the call.
Thank you very much, Rich. We're gonna end this little share here. Does anyone have any questions?
I did ask in the chat a while back if there was any comments on U.S. materials infrastructure, but I guess that's pretty far afield. So
No, that's fine. Tony, you have any thoughts on materials and infrastructure?
Well, look, I think that China's stimulus is going to affect material prices because the Chinese are the biggest consumers of many, if not most of these materials. And I think, as I said, I think that one thing that we should worry about in the future is that this will make the Fed's life much more difficult because inflation is going to get worse pretty quickly. I mean, I have zero respect for the Fed, so I don't know what they're going to do. Probably try to talk their way out of it.
Well, the inflation will probably be transitory, Tony.
I'm sure. Yeah.
So is that 3 to 5 years transitory or 7?
More like 70. I mean, look.
Thank you.
The dollar has lost 98. The dollar has lost 98% of its purchasing power in the last 100 years or something. So I think people who talk about transitory inflation either have Alzheimer's or a very short memory.
Thank you.
Any other questions? Well, thank you, everyone. I thought that was a riveting discussion. Any burning desires here? Okay.
Well, yeah, I have a crazy speculation for a trade that I'll mention, and that is the domestic marijuana stocks. And the reason I like these things for a trade is because marijuana is supposed to get declassified. Now, first of all, which would mean that it goes from a class 1 to a class 3 substance. Now, the big point of this is that if this happens, then they stop paying taxes on gross margins, but they pay taxes on net margins like most other companies, which is a very big deal. And I think if marijuana is going to be declassified, it should happen before the election, because there are a lot of voters, particularly Latin and Black and colored people, who think this is an important issue. So that's one thing. The other thing that's received much less attention than I would have thought is that Donald Trump has said that he's in favor of recreational marijuana in Florida. Now, in Florida, medical marijuana is widely sold, but recreational marijuana is still prohibited. But I think that this statement by Donald Trump, unless he changes his mind, which he very often does, but if he sticks with this, I mean, this is a very big deal long term, and maybe short term for this industry. So the stocks are selling close to their lows. No one is interested in them. And I think that this could create some interest. Now, having said that, I want to distinguish between the American companies and the Canadians. The Canadians, which are widely traded here, it's a totally different animal. The Americans are traded largely in the pink sheets. Some brokers won't let you buy them. If you want to do this and have a broker who doesn't like these stocks, there's an ETF. I don't know what it's called, but its symbol is MSOS, and it trades around 7. And again, this is a trade. So we'll see.
Thank you. Any last questions? Going. Thank you all.
Thank you, Tyson.
Thank you, Tyson.
Thanks.
Okay, thanks, everyone.
Thank you, Tyson.
Thank
Bye-bye.
you, Tyson.
Thank you,
Thank you,
Rory.
Tony. Thank you, Charles.
Thanks, guys.
All you guys were
Thank
good.
you, everyone.